Well, welcome to today's webinar on the 2013 tax update. I'm Dan Matarrese. I'm joined by Mike Eby, and today we're going to spend some time talking about some individual changes for 2013 as well as some changes for businesses for taxation. We're going to focus a lot of time on the provisions of the American Taxpayer Relief Act of 2012, commonly called the Fiscal Cliff legislation, but we're also going to talk about some changes that start or take place in 2013 from other acts, the Affordable Care Act and some other tax legislation that was passed over the last couple of tax years. So without further ado, let's jump right into the material.
Now, Dan, as I was watching a lot of the debates in Congress back in December, what I was hearing a lot about was the Bush tax cuts being extended or not being extended for certain taxpayers. What exactly has been enacted through the American Taxpayer Relief Act? What type of rate brackets are we looking at?
Mike, that's a great question. A lot of the focus of the debate, whether it was in Congress or in media, talked about these Bush tax cuts as we knew them. I always pointed out that it was odd enough that they were called the Bush tax cuts because President Obama extended those cuts for the first 4 years of his administration as well. So technically they were the Bush and Obama tax cuts, if you will. But what we had is we had the potential of reverting back to Clinton-era rates, which means that taxes would have gone up for everyone. But what Congress agreed to and what was signed into legislation was the permanent extension of what is known as the Bush-era tax brackets. And what that means is we have a 10% bracket, a 25% bracket, a 28, 33, and 35% brackets, which is what Bush put in place starting in 2001. The big change is we've added a higher bracket for married individuals whose taxable income is over $450,000. Single individuals, it's over $400,000, and that is for taxable income. Again, would be taxed at 39.6% if your taxable income is over those thresholds. So we, in a sense, have a hybrid of the Clinton-era tax rates and what was known as the Bush-era tax rates. For those who are under the thresholds that I just discussed, the $450,000 for married individuals, $400,000 for single, you will see the exact same tax rate structure as you had previously. But those with income over those amounts their next dollar, their marginal tax rate will be 39.6% as opposed to 35% that it was previously.
Now, the rates you're discussing, that's for ordinary income tax. What about capital gains rates? Qualified dividends? What type of rates are we looking at for that?
Great question. Again, what we had in place previously was there's actually two different long-term capital gain rates. And when I say long-term, it means capital gain rates for assets that you held greater than 1 year. So stock or mutual funds or bonds that you had for more than a year. If it was pass-through income from a pass-through entity, it would have been 1231 gain for assets that were held longer than 1 year. The rates were 0% and 15%. And the way it was broken down is that if you were in the first two income tax brackets, the 10 and the 15% income tax brackets, your capital gains were actually taxed at 0%. And that was for 2010, 11, and 12. Anyone else, any other rates that you would have been, any other bracket you would have been in, you would have had a 15% rate for long-term capital gains. Those were extended as part of the American Taxpayer Relief Act. But those individuals who are in the highest income tax bracket that we just talked about, and those are individuals as a married couple that have taxable income over $450,000, they will pay 20% on long-term capital gains to the extent that it is into that highest bracket, that $450,000 and above. These same rules and these same rates were extended to apply to qualified dividends. Qualified dividends was a concept that Bush introduced as part of his tax legislation that essentially says dividends from a U.S.-based company or certain qualifying foreign companies, C corporations specifically, dividends that were paid to shareholders would get the preferential rate of long-term capital gains. That was a provision that was set to expire at the end of the year, and everyone was worried about the effect it would have on the market and how it would affect, our different indexes and potentially how it would change the viability of some dividend-paying strategies. Well, that was extended. So again, a dividend from a U.S.-based C corporation, as long as you meet the certain requirements, and there are certain requirements in how long you've held the stock as it's compared to the dividend declared date, you would get the long-term capital gain rate on that dividend. So now in 2013, you will either pay one of three rates, as we talked about, 0, 15, or 20%. on long-term capital gains and qualified dividends, depending upon what tax bracket you are in when you consider all of your income.
Okay, well, let's play this out for an example here, because let's say we have a married filing joint taxpayer, and as you previously discussed, their rate would be, at the $450,000 income level, would be 39.6%. Let's say this married filing joint taxpayer has $400,000 of wages and then another $75,000 of qualified dividends. How is that dividend taxed?
Great question, Mike. So let's assume in your scenario that the $475,000 of total income is their taxable income after itemized deductions, and the makeup of it is $400,000 of it is ordinary income, as you alluded to, and $75,000 is qualified dividends. The limit for the highest tax bracket is $450,000. So from $400,000 to $450,000, the first $50,000 of their long-term capital gain or qualified dividend income, that would be taxed at 15% because it is still in every bracket other than the highest. The next $25,000 of qualified dividends would be in the 39.6% bracket, and it would be taxed at 20%. So it's also a good time to bring up how some of the Medicare surcharges from the Affordable Care Act are also in place. The Affordable Care Act put in place a 3.8% surcharge on net investment income for those taxpayers that have AGI in excess of $250,000. So if you are in the highest income tax bracket, which is taxable income of over $450,000 for a married couple, you surely have AGI over $250,000, which means in addition to paying 20% or a higher rate on long-term capital gains, you will also see the 3.8% Medicare surcharge attached to your net investment income, which includes capital gains, qualified dividends, and even interest income that you would receive. Further elaborating on the Medicare surcharge, it also applies to earned income. Traditionally, the Medicare contribution that we all pay is on all earned income, and it was 2.9% for a pretty long time. The Affordable Care Act takes it from 2.9% to 3.8%, so an additional 0.9% on earned income for those taxpayers who have AGI above $250,000 if married and $200,000 if not married. So that 3.8% is also then applied to net investment income, and that's how the surcharge is formulated in total. So again, the highest income tax bracket goes up to 39.6%, plus you take the Medicare contribution from 2.9 to 3.8% for taxpayers above $250,000 of AGI. Long-term capital gain rates go from 15 to 20% for taxpayers who have taxable income above $450,000, and the Medicare surcharge of 3.8% also applies to taxpayers with AGI above $250,000. So more individuals will be subject to the Medicare surcharge, whether it be the additional 0.9% on earned income or the 3.8% on unearned income, than those that will be in the highest tax brackets. The 39.6% bracket or the 20% bracket for long-term capital gains, if you will, it requires higher income than the Medicare surcharge does as far as when it kicks in.
Now, you mentioned the additional 0.9% Medicare charge on earned income. How businesses withhold for that? Let's say there are a spouse or a husband and wife, and they both earn $140,000 of wages each. That's going to take them up to $280,000. Mm-hmm. When do you start withholding? If they're under withheld or over withheld at the end of the tax year, how do they account for that on their individual tax return?
That's a really good question, and the IRS actually addressed that with some regulations toward the end of 2012. And essentially, employers have to withhold the additional 0.9% Medicare surcharge on the first dollar of wages that exceeds $200,000, regardless of what the taxpayer's filing status is and what they elect on their W-4. So the first dollar of wages over $200,000, you will see the additional 0.9% surcharge deducted from your pay as an additional Medicare tax. It is only on the employee side of the Medicare contribution, not the employer side, only on the employee side. Mike, to your point, that's if their AGI is above 200, or their wages, are above 200. In your scenario, where both couples are making $140,000 each, and that means that their AGI, all things being equal, if they have no other sources of income, their AGI would be $280,000. In that case, they're subject to the surcharge, but they never eclipse the withholding threshold. They will then be assessed the surcharge on their individual income tax return, and they will pay the additional 0.9% to the extent that their AGI exceeds $250,000. They'll pay it on their tax return, similar to how self-employed individuals pay the self-employment tax or SC tax at the time they file their tax return. Conversely, let's say you have a married couple. One of the individuals is working and the other is not. Let's say the one individual that is working has $225,000 of wages. That's the only income the couple has. The employer would be required to withhold the additional 0.9% on $25,000 of the wages, the amount that it exceeds $200,000. But when it comes time to file their return, they will not be subject to the additional Medicare surcharge because their AGI would be below $250,000. In that case, they would receive a refund or a credit for the amount that the Medicare tax had already been withheld, similar to if you work for two employers and max out your Social Security contribution, that when you file your tax return, you get a refund of your Social Security tax that was paid in excess of the threshold. The same would be true in the case of the Medicare contribution if it is withheld, but you don't actually have to pay it once it comes time to file your return.
So to clarify, an employer has no responsibility to figure out what its employee's spouse is getting paid, essentially, as long
Correct.
as they're withholding beginning this additional 0.9% Medicare tax, beginning with $200,000 of wages paid to their employee.
Correct. And the IRS simplified the approach to put something out there, draw a line in the sand and say, you're going to withhold over $200,000 regardless of their filing status, and then it will be trued up, so to speak, on the individual's income tax filing.
Good to know. Now, Dan, one topic that comes up in debate every December and right before tax season every year is the alternative minimum tax, more commonly known as AMT. Why was that so important that got passed timely, meaning before tax season essentially began? I was actually even reading an article as well the other day stating that 4 million taxpayers in the U.S. were subject to AMT in 2011. And if this act was not passed, 30 million taxpayers would actually be subject to it in 2012, meaning this 2013 filing season. Mm-hmm. What has been done with AMT?
Well, awesome question. And AMT is, again, one of those buzzwords we've heard in media and we've heard politicians talk about a lot during the year. Essentially, AMT, as Mike alluded to, is alternative minimum tax. And the best way to think about it is a parallel tax system. It starts with your normal income after itemized or standard deductions, as figured out under normal tax rules, and then either adds back or deducts from there certain items that have been included or not included in your normal income tax calculation. For example, in normal income tax purposes, you get to deduct in real estate taxes or state and local taxes you pay. AMT adds those back. The AMT was originally enacted to prevent certain, as they deemed, wealthy taxpayers from getting too much of a benefit of certain deductions. But over the years, it has slowly crept to affect more and more middle-income taxpayers. And as Mike, you alluded to, 4 million taxpayers were affected in 2011. And without this recent change, 30 million would have been affected. The change is what we call the AMT exemption. After figuring AMT taxable income, we each get an exemption amount. It's $50,600 for unmarried individuals in 2012 and $78,750 for married or joint filers in 2012. Those are the extended amounts that were part of the American Taxpayer Relief Act. If those amounts were not extended or if legislation was not reached, the exemption amount for married couples would have been $45,000, and for unmarried or single individuals, it would have been $22,500. So you would have had more individuals being subject to AMT. And now AMT essentially is a flat rate. It's a combined rate. It's about 26% on your first $175,000 of income roughly for married individuals, and then 28% on anything above that. It would have applied that rate structure to a lot more individuals given the AMT exemption amount, and would have forced a lot more people to pay almost what is a flat rate of 26 or 28%, as opposed to those individuals normally being in potentially the 20% or the 25% range on their income taxes. The important thing about the legislation, beyond the fact that it extended or increased the exemption amounts for 2012, is it made those exemption amounts permanent, and they set them to adjust every year for inflation. Since 2001, those AMT exemption amounts, they were always temporary fixes to increase them for a year or two at a time. So frequently, us in the tax world, we waiting every December to know when they would have extended them. They made those large increases permanent. So that means that next year, 2013, even if they do nothing, the lowest that the exemption amount could be is $78,000. You don't have this potential of the AMT exemption amount going back down to $45,000. Which, 2001 or pre-2001 rates. We reset the floor, so to speak, and then set it to adjust for inflation every year. Adjusting for inflation every year means that all we have to do is wait for the IRS to make its calculation on inflation adjustment. We no longer have to rely on our friends from Washington to pass new legislation every year to essentially prevent millions and millions of taxpayers from being subject to AMT.
Well, that's good because we really don't like procrastination.
Very true.
Well, that is very interesting, though. So AMT, unlike a lot of what we are discussing today, affected something in the past. It's retroactive, 2012, meaning this tax filing season, the AMT would have come into play if we did not have this so-called AMT patch. Is that why the IRS is pushing back the first date where they'll be processing returns to January 31st this year?
Absolutely, and that's such a good point, Mike. We've heard a lot about the IRS being delayed in getting forms ready, tax software companies being delayed in releasing the tax software, and a lot of it had to do with the AMT. The IRS was ready to go, and their commissioner had even stated that all along they were prepared and operating as if the AMT exemption would have been extended, but they still had to wait for the final amounts and the final tax law to release the forms. So because of that, those individuals who wish to file early in January have not been able to, and will have to wait to the end of the month, and that will be when the IRS first starts to accept electronically filed returns. This is probably the most popular provision that affected the 2012 year. There are some smaller ones that we probably won't be able to hit on all of them today. There's some other smaller provisions that affect 2012, like the deduction of the educator expenses and qualified tuition and fees deduction that come into play. But again, this was the largest one, I think, that was retroactive to the first of the year, providing a little bit more clarity on how things will be taxed this year and then also going forward.
All right, well, two other provisions that were extended into 2013. These two items did not get nearly enough press. And to be honest, they don't affect as many taxpayers as, for instance, AMT would. But Peace and PEP, itemized deductions, the phase-out for that, as well as the personal exemption phase-out. That's only applies to certain high-income taxpayers. What exactly is this? How does it work? And what does this extension provide for?
That's a great question. And Mike, I think this is probably one of the most misunderstood provisions of individual income taxes. I heard certain individuals, high-profile former White House press secretaries, tweeting about this soon after it came to be. We'll start with the overall limitation on itemized deductions. And just to set a little bit of perspective, this was in place for many years, dating back from the 80s till 2009. As part of the Bush-era tax cuts, he had this itemized deduction limitation set to expire, and it did expire in 2010. It comes back in 2013 with higher limits. Essentially, the way it works is that if you are a married couple and your AGI is above $300,000, you will lose 3% of your itemized deduction. You will lose a portion of your itemized deduction equal to 3% of the excess of your AGI over that $300,000. So if your AGI is $310,000, you would be over by $10,000. You would take 3% of that, which is $300. You would lose $300 of your itemized deductions in total. So your taxable income would be higher by $300 times whatever tax rate you'd be subject to. Again, you have a different income amount that comes into play here. It's AGI of $300,000, and it's $250,000 for non-joint filers. It can be a large decrease for high-income individuals, but it's tough to specify exactly how much it will affect people because it's dependent upon the ratio of their itemized deductions versus their AGI. To see how much they're affected by this. This does lessen the tax benefit of all itemized deductions with the exception of a few. Medical expenses and investment interest are two that you can name. But your general itemized deductions are affected by this. However, a lot of the taxpayers that would otherwise be subject to this limitation are in AMT or pay AMT tax, which means that they don't get the benefit from a lot of these deductions to begin with. This is not a very large revenue raiser as compared to other provisions in the American Taxpayer Relief Act. I don't want to minimize it, but I also don't want to make it seem that all of a sudden there's no tax benefit to giving money to charity. There's still a very large tax benefit to it, and the same is true for your other itemized deductions. Switching to the personal exemption phase out, it's a little bit different. This will actually take down your personal exemptions a little bit further, and the way this works is that you lose 2 percentage points of your personal exemption amounts, which are $3,800 for 2012. They'll be adjusted for inflation for 2013. For every $2,500 that your AGI is above $300,000. Again, it's a pretty detailed calculation, but all it says is that if your AGI is above $300,000, you're going to start to lose a little bit of the benefit from the $3,800 that you get as a personal exemption for yourself, your spouse, and any dependents that you have. Again, if you're an AMT, which a lot of taxpayers are that have AGI between $300,000 and $500,000, you never got the benefit of personal exemptions anyway. So this provision alone will not make you pay more income taxes. It actually puts you in a neutral position as compared to previously. But again, all we're saying is that the itemized deduction and personal exemption limitations are back actually to a lesser degree than they were in 2009. In 2009, it affected married couples with AGI above $166,800 to be exact, and now it's only affecting married couples with AGI above $300,000. So not talked about as much in the media, probably not as impactful as some of the other provisions, but nevertheless it's a change to how we treat itemized deductions and personal exemption amounts.
Now, something I heard a lot about the last couple of years from fellow practitioners and state attorneys was the state tax significantly increasing in 2013 and beyond compared to what I guess would be deemed more favorable the last few years in terms of how a person's estate and gift taxes are taxed. What's happening for 2013?
Another real timely question, Mike. In 2009, the estate exemption was $3.5 million. So for a married couple, as long as they had proper planning and trust in place, they could pass away and then leave $7 million in total to their beneficiaries, estate tax free. In 2010, as we know, President Bush actually put in place, when he was in office, a temporary expiration of the estate tax for 1 year. And then it was set to come back in 2011 at the pre-2001 rates, which were a $1 million exemption. President Obama and his administration, to the applause of many of us practitioners and individuals, brought the estate tax back in 2011, but with a $5 million exemption, a higher exemption for individuals. And they also made it even more favorable that you could give away your full lifetime exemption, the full $5 million, during your lifetime. 2009, of the $3.5 million exemption that existed, you could only give away $1 million during your lifetime. So 2011, we have a $5 million exemption, $10 million for a married couple. You could give away the full $10 million in your lifetime. And they also put in place provisions which we like to refer to as the portability of the exemption. It basically allowed a surviving spouse to automatically use any of their deceased spouse's exemption that was not used at his or her death. Previous to that, you needed planning tools called a bypass trust or credit shelter trust to allow for the preservation of that exemption. All that was set to expire at the end of 2012, which means as of 1/1/2013, we would go back to a $1 million exemption taxed at the highest rate. I think some advisors may have used this as motivation to force people into planning, which is unfortunate. Other advisors use this for the motivation that families needed that otherwise needed to do some planning, and use this as a reminder that we should take advantage of these favorable rules while we have them. What ended up happening is they extended all of the 2009 and 12 estate tax provisions and gift tax provisions, which means we have a $5 million exemption that was actually adjusted for inflation for 2012 and 13. In 12, it was $5,120,000, and in 2013, it's $5,250,000 as far as an exemption. You can give away the full amount during your lifetime. The one change is that the highest rate increases from 35 to 40%. So if your estate is above those limitations and you have a taxable estate, the highest rate it will pay is 40% versus what it used to be at 35%. Not a large change. The estate tax as it stands affects less than 1% of the population, so it doesn't garner a lot of attention going forward. And the important thing about this is that it made those rules permanent. So we're not going to be faced with another deal where we have to act before the end of the year, or Congress has to act before the end of the year, unless we go back to a $1 million exemption. Right now, we made these amounts permanent, meaning unless there's new legislation to adjust it, we have this $5 million exemption. Getting back to the families that may have done some planning, we had a lot of clients that did some planning towards year end because this served as the extra bit of motivation that they needed. And I applaud those clients, and I still think they took the right steps to plan for their family and the preservation of their wealth. So I think it was good in some senses that we had this reminder to utilize the favorable laws when we have them. But I also think that some advisors maybe took it as an opportunity to expedite or force clients into planning that weren't otherwise ready or didn't have the other motivating factors in place.
Now, the estate tax continues to be better than it was a decade ago.
Correct.
Is this tax here to stay?
As it is right now, from a permanent standpoint, I guess legislatively, it is. However, you could always have adjustments and changes to the law. I don't believe that the current administration is focusing on estate tax. The increases that we're seeing from the current administration is more on the income tax side, as we spoke about. We have more increases coming to what they deem as wealthy taxpayers, the addition of the 39.6% bracket, the Medicare surcharges, but they have actually been, the current administration and Congress has actually been more lenient towards the estate tax. It seems that there's a consensus in Washington that they would get rid of the estate tax if they could. I mean, they're making these levels very high, and there's a lot to work with from a planning perspective to help your clients avoid estate taxes or gift taxes even at this point. So I would say right now that the focus is not on generating revenue from estate or gift tax. The focus is more on the individual income tax arena.
So if I'm hearing correctly, the old saying of the only thing certain in life is death and taxes, it still applies to the estate tax, and in that case, it goes hand in hand.
Absolutely, Mike.
That's just accounting humor.
So, Mike, we talked about some of the individual income tax provisions of the new act and also some from the Affordable Care Act and how they may come into play in 2013 and even also in 2012. Can you speak a little bit about some of the business aspects? Specifically, we'll start with an area that had a lot of uncertainty, and that's fixed assets and depreciation. How may those rules, or how may have those rules change in 2012 and going forward?
Sure, there weren't many business deductions that were extremely highlighted in the media coverage during the fiscal cliff, or at least the tax portion of the fiscal cliff debates. But one that did receive a fair amount of attention, and for definitely important reasons, was the bonus depreciation deduction. Just to give you some background and history on bonus depreciation, Congress originally installed this into the Internal Revenue Code, Section 168K, right after 9/11. It's for assets, certain qualifying assets that were placed into service beginning September 11th, 2011, and it lasted for several years. Originally, the rate was 30%, where you could expense 30% of the asset initially that you place into service, with the rest being depreciated over the normal useful life of that asset. After a short while, it increased to 50%. Then it went away for a few years in 2006 and 2007, but returned again in 2008 at 50%. In September 9th, 2010, legislation was actually passed to increase the bonus depreciation to 100%, and that lasted through 2011. So essentially, you were able to take immediate expensing of all assets that qualified that you placed into service between September 9, 2010 through December 31st, 2011. And just to take a step back, what is a qualifying asset? It's Typically it's tangible personal property. It's assets that have a tax life for makers less than 20 years, and they have to be brand new. You can't buy an asset that's been used by someone else and then you purchase it. Commonly what I see that is in vehicles, if you're purchasing a late model vehicle, which already has a listed property threshold, which we'll discuss in a few seconds, but it's only qualifying for brand new assets. And then in 2012, bonus depreciation went back to the 50% rate prior to what it was prior to September 9th, 2010. And then it was scheduled to expire completely at the end of 2012 until Congress extended it for 2013. And with the extension, they kept the same rate at 50%. So the important thing to keep in mind there is that 50% bonus is still eligible for assets placed in the service prior to January 1st, 2014, and for certain long production property placed in service before January 1st, 2015. For autos, there are slightly different rules. Business autos include lightweight trucks and vans. You're limited to the amount of depreciation you can take in a year on these type of assets. They're actually considered listed property. Now, if bonus had not been extended into 2013, the maximum amount you could take on autos and, like I said, lightweight trucks and vans was $3,360. However, with the extension of bonus, that increased the amount to $11,360 for the amount that you could take on eligible automobile acquisitions in 2013. $8,000 of that is the first-year bonus depreciation. And again, like I said, make sure these assets are actually brand new. You cannot take it on a 2011 vehicle, for instance, that you're purchasing. You would be required to only take the $3,360 depreciation. And the AMT credit in lieu of bonus depreciation, this was also extended with the Act. It allows entities with NOLs to claim the refundable AMT credits instead of the bonus depreciation. Entities that are currently having an NOL really would not benefit from the immediate expensing of assets. So to encourage asset investment, the IRS instilled this provision to allow taxpayers that are in a loss situation to still receive money back for placing assets in the service and electing to take a credit in lieu of the bonus depreciation. Another extension that's fairly similar to bonus depreciation is Section 179 deduction. This was not set to expire, but what was set to expire was the amount of deduction that you could take, as well as when the deductions phased out. In 2011, you could take up to $500,000 of Section 179 for qualifying assets placed in the service. Now, qualifying assets that are placed in the service is fairly similar to the definition of what bonus depreciation qualifying assets are. It's typically tangible personal property. The big distinction between Section 179 and 168K, bonus depreciation, is that Section 179 qualifying assets, they do not have to be brand new. You could be purchasing a previously used asset as long as it's new to you. But in 2012, the deduction limit went down to $139,000 with a phase-out beginning at $560,000 of qualifying 179 assets placed into service. The way the phase-out works, it's a dollar-for-dollar phase-out of the deduction beginning at $560,000. So if you do the math, at $699,000 in 2012, your 179 deduction would have been completely eliminated if you had that many assets placed into service that qualified for 179. So a lot of very large companies would definitely not qualify for Section 179 at those rates. And even worse, in 2013, it was scheduled to drop down to a $25,000 deduction for 179 with a phase-out beginning at only $200,000 of assets placed into service. So what the Act did, it retroactively extended into 2012 the $500,000 deduction with the $2 million phase-in, or phase-out, I should say. And it also extended it into 2013, which was a very large increase then. If you're thinking $25,000 eligible in 2013 compared to what it will now be is 500,000. One thing to keep in mind, this is a temporary extension. In 2014, both for bonus depreciation and Section 179, it will revert back to the way it was prior to this act being created. So in 2014, 179 will be back down to a $25,000 deduction with a phase-out beginning at $200,000.
Mike, those are some awesome things to point out on the fixed asset side. I know there was certainly a lot of uncertainty on when to put assets in service, what depreciation to claim in lieu of rising tax rates. So that certainly provides some clarity. I know specifically for another group of assets, we had a tough time planning and helping our clients plan for how certain assets would be treated, specifically leasehold improvements. Can you talk about how the extensions or the legislation may have changed or extended some provisions as it relates to leasehold improvements?
Sure. It's always difficult, I think, with retroactive extensions. It especially comes down to depreciation. You're making planning decisions for tax all year long, and by the time the end of 2012 comes, you would like to have a good idea of what your taxable income is going to be.
Very true.
Now, for bonus depreciation, it was going to be 50% no matter what for 2012. However, Section 179, as I previously stated, there was only a $139,000 eligible deduction with a much lower phase-out level. With that retroactive increase to $500,000 deduction, all of a sudden, you could significantly lower your taxable income. Same thing is true with qualified leasehold improvements. Qualified leasehold improvements, the provision that allowed that to be a 15-year straight line taxable life expired at the end of 2011. So in 2012, qualified leasehold improvements were actually subject to a 39-year straight line life as non-residential real estate property. What the act did is retroactively make it a 15-year straight line life. Now, the really strange thing about this, with the expiration of the qualified leasehold improvements at the end of 2011, was that for 2012, even though they were considered to be a real property asset addition opposed to a tangible personal property addition, which typically is not then qualifying for bonus depreciation, at the 39-year life, they were still qualifying for bonus depreciation, which was a really strange caveat. All that's to be said is it doesn't really matter anymore. They're back to the 15-year straight line life, still eligible for bonus depreciation, and that is both retroactive for 2012 in addition to being extended for 2013. Another point I would like to highlight is the IRS amended temporary repair versus capitalization regulations. Now, I want to specify this is not included in the American Taxpayer Relief Act, and I will highlight a few tax planning items that are specifically not in this act, and I will mention this one later. However, I thought it would be good to throw this in with the fixed assets and depreciation. Truth be told, we could do a whole seminar on this notice, Dan, but we're kind of limited. We have a lot of things to cover. So to generalize, the requirements of this act in determining what's considered a repair item and can be expense to me, what needs to be capitalized, there's a lot that goes into this. It's been debated for several years now. There was a lot of uncertainty out there, and this regulation, along with a subsequent follow-up by the IRS, has provided a lot of clarity. And the main item that we need to take away from this is that the requirements specifically of this regulation contained in this Notice 2012-73 are delayed until January 1st, 2014. So if you don't want to do anything, you don't want to change anything, you have till January 1st, 2014 to take heed and change. However, if you would like to begin abiding by the regulations, the IRS has given the option to taxpayers to instill these new procedures in their 2012 and 2013 tax years. So it is kind of a best of both worlds with this notice.
Yeah, Mike, great point. And I think you can expect more from us in the ways of communication and webinars during 2013 as more clarity comes out on those temporary regulations. And we can certainly make sure that our clients and referral sources and and friends in the community have a good understanding of how they may affect your businesses. So expect more from us in the following months on those issues. Mike, in addition to the changes or extensions for fixed assets and depreciation, what other implications do we have for business tax credits and certain deductions as a result of the Taxpayer Relief Act?
There was a number of credits extended, Dan, but the first two that I have listed there, research and development tax credit, more commonly known as the R&D tax credit, and the work opportunity tax credit, commonly referred to as WOTC. These credits, at least on the R&D side, was gone after 2011, and parts of the WOTC credit were also gone after 2011. So there was some uncertainty in 2012 whether this credit would be available. I know for a number of our clients, they take advantage of both of these credits. I think what reassured us, other tax practitioners and businesses, was that these two credits are heavily derived on a calculation of qualifying wages. Obviously, the WOTC would be, but even the research and development, a lot of the credits based on how much wages you have involved in the research process. And obviously, with unemployment rates continuing to be quite high, these were two credits that the IRS and federal government had no intentions of removing anytime soon. So, as we expected, both credits in their entirety were extended 2013 and retroactively extended for 2012. I'll start off with the research and development credit first. Not only was this extended, but the Act actually liberalized a few of the provisions. One of the key ones was that you can now include expenditures of a predecessor company that you acquire during the year and be able to use that within your qualifying wage base. So if you had acquired an entity that does some significant research and development, there could definitely be a credit there during the year that you acquire them. Definitely in my opinion, but within our firm and within the profession, this was a pretty important extension. There's a number of businesses that qualify for this credit, and a lot that aren't even taking the credit and don't realize that they could qualify for it. The important thing to remember about the research and development credit is that you no longer have to be a cutting-edge scientific or technology firm to qualify for this credit. The credit can often be taken for expenditures to create a product or a procedure that is new to your business, not necessarily new to the industry as a whole. So this really has opened up the door for many contractors, manufacturers, and even some retailers to be eligible for this credit. So if you do any research and development, this is definitely a good time with it now being extended, and this is something that will probably continue to be extended beyond 2013 to consult your tax advisors about potential opportunity for this. The WOTC credit, just briefly, the credit is based on hiring certain targeted groups of employees. Now, when I say it was retroactively extended to 2012, not the entire WOTC credit was not gone after 2011. However, non-veterans, hiring non-veterans was no longer eligible for 2012. Only veterans. So when the act passed, it retroactively extended the credit for both veterans and non-veterans for 2012, and then continues for 2013. Lastly, the low-income housing tax credit. The minimum tax rate for that for rehab expenditures continues to be 9%. Another deduction that kind of piqued my interest. This is one that we probably doesn't receive a lot of attention, but there are definitely certain industries that this would be applicable for. The enhanced deduction for food inventory, extended to 2013. What this allows is if you're making a contribution of food from your inventory, you're able to take not only the basis of the property as your deduction, but you can take the lesser of the property basis plus 1/2 of the appreciation, or twice the basis of the property. Now, this credit's available for pass-throughs in addition to C Corp, but it kind of follows the C Corp's rules in that you're only allowed the deduction up to 10% of your aggregate income, which is actually the threshold for C corporations. As you know, pass-through entities, S corps and partnerships, the deduction for charitable contributions is taking at the individual shareholder level, which is usually subject then to 50%
Correct.
limitation rules. So that's just something to keep in mind about the 10% rule with that. Domestic productions activity deduction. This is a common one that a number of taxpayers take. Real briefly, the DPAD, also known as Section 199, it's provided for taxpayers that create new products in the U.S. based on domestic wages paid in the U.S. This can be done through a manufacturing operation or a construction operation. And what was extended in the Act for 2000 and retroactively extended to 2012 was that Puerto Rico it should be included in the U.S. calculation. But that's only if the Puerto Rico gross receipts are includable as taxable gross receipts at the federal U.S. level. And then lastly, many energy-related tax provisions have been extended. There are quite a few. There's so many to go into that, due to time constraints, we're not going to go into. But alternative fuels, renewable energy are a few things. Wind is a big one. If you are in that industry or you are thinking of doing improvements for energy efficiency, definitely something that you should look further into.
Mike, those are great summaries of some of those items that come into play on our 2012 returns and beyond. There was a couple other isolated ones that we thought were pertinent to touch on. The first is which has a little bit of a change to S corporations and the built-in gains tax. Can you talk a little bit about that and some changes that we have for 2012 and beyond?
Yeah, the built-in gains tax, also known as BIG, it's kind of a really nagging tax under Section 1374. It applies to S corporations that were previously C corporations. Unlike most taxes, or income tax, I should say, at the S corporation level, which is passed through, this would be an entity level tax assessed on the S corporation. And it's assessed based on the unrecognized built-in gain at the time of the conversion from the C corp to the S corporation. Mm-hmm. So if your assets were a higher fair market value than your basis at the conversion, with some other rules applied, but that would be what would be subject to the built-in gains tax when these assets are eventually sold by the S corporation. Now, the nice thing is the IRS does allow for an exclusion of built-in gains tax if the assets are sold 10 years after the conversion. Mm-hmm. So essentially there was a 10-year look-back period. For 2009 and 2010, the look-back period was only 7 years. And in 2011, it was 5 years. 2013 was going to revert back to 10 years, but now it's, again, been extended to 5 years, which is a very good thing for S corps that were previously C corps. It is kind of funny if you, with the years changing from 2010, 2011 to 2011, and then back to the way it would have been in 2012 and 2013. If you had an S corp that converted from a C corp that converted to an S corp back in 2005, they would have been subject to the built-in gains tax in 2010 because the look-back period was 7 years. They wouldn't have been subject to it in 2011 because the look-back was only 5 years. But then, before this act was passed in 2012, they'd be subject to it again. So I think the 5 years is definitely a good thing if you are an S corp in this situation. And then the last miscellaneous provision of this act that we wanted to highlight is the 20% capital gains and qualified dividends rate, and that's for the top marginal bracket of individual taxpayers. And you might be asking, why are we including this on our business portion of this update? And you're right, it is a tax based on assessed at the individual level, but a lot of C corporations, especially smaller C corporations that only have a few shareholders, their business decisions of whether they're going to make a dividend at a certain period of time could be depending on who their shareholders are and what tax bracket they're in. Some corporations in 2012, with the extreme uncertainty of where the rates would be for any taxpayer for qualified dividends, decided to make a large dividend in 2012 at the end instead of 2013. We were advising a lot of our clients if if you were planning to make a dividend in early 2013, might make sense to make the dividend in 2012. If it's not, if it's not a out of your ordinary business, if we're talking only a few months delay, just to make sure, because we were pretty sure that the rate would go up for certain taxpayers,
Right.
And it in fact did. But if these corporations made large dividends, I'm thinking more publicly traded, made large dividends in 2012 and now are having cash issues, that probably wasn't very prudent on their part.
Very true.
But again, that's something that a position that Congress puts us in sometimes when these acts are slow to be passed.
Very true. I think it's a great point, Mike. A lot of these decisions were dependent upon those treatments, and we always say don't let the tax tail wag the dog. We don't want to make decisions purely because of tax, but when it affects the amount of cash in shareholders' pockets, we can certainly understand why people use it as such a large motivating factor. So, Mike, what are a couple or any provisions you think are worth mentioning that may not have been part of the American Taxpayer Relief Act of 2012, but are coming into effect in 2012 and 2013?
Now, there's just a few that I briefly want to highlight, and we're going to go over them really quick. So if you would like additional information, feel free to contact Dan or I. Our email addresses will be on the last slide. The 1099-K reporting feature, this is currently in place, very similar to the requirements of the 1099 miscellaneous right now. However, it's for credit card companies and other third-party entities that handle third-party payments. So if you are a entity that accepts credit card payments as part of your gross receipts, be on the lookout for these 1099-Ks in the mail. It's not something that will be separately stated on the tax return, as a lot of businesses were worried about would be the case. The IRS has backed off on that. Secondly, the 2.3% excise tax on medical devices. This is beginning in January 1st, 2013. And unlike sales tax, the excise tax is actually due from the importer or the manufacturer of the device. And then third, the business standard mileage rate increased by 1 cent in 2013. And then lastly, the repair versus capitalization regulations that we discussed previously, and there will be more to come throughout the year as the IRS releases further clarity and as we get closer to the 2014 due date of those provisions taking place.
Mike, you've done a great job of kind of outlining what's in store for businesses in 2012 and 13 in the federal level, but I think it would be wouldn't be as complete if we didn't talk a little bit about Pennsylvania and how a lot of the new provisions or certain provisions for PA are affecting companies for the 2012 and 2013. Spend a little time talking about some noteworthy items that you believe are worth mentioning for Pennsylvania specifically.
Sure. With a number of our listening audience actually doing business in Pennsylvania, there are a few key items that I would like to highlight that are right down the road here or taking place as we speak. The first one is the Form 1099 miscellaneous requirement for Pennsylvania. The thing to keep in mind here is it's almost identical to the IRS regulations. If you're reporting PA-sourced payments for non-employee compensation or for oil and gas leases, you're going to need to also send a duplicate copy to the Pennsylvania Department of Revenue. Same thresholds, the $600 minimum threshold, as well as the same due dates for filing. I believe it's February 28th for paper filing and April 1st for electronic filing. And if you're a Pennsylvania business and you already have employer withholding, you could actually file electronically through the e-Tide system. If you don't have employer withholding, you're going to have to end up paper filing that. And that's actually effective for the 2012 year. So currently, the 1099 miscellaneous reporting season that we are in, you will also need to remit a duplicate copy to Pennsylvania. The second item is the Department of Revenue Computer Modernization Project. Two things that will affect taxpayers with these specific items. If you don't know the background on this, the Department of Revenue computer system is very archaic. If you've received notices in the past that just don't make sense, you could probably blame it on the computer system that they have at the Department of Revenue. So it's over the past several years, it's gone through a major modernization project, and a lot of the finality of it will take place in early 2013. What this will cause is new PA tax account numbers for businesses beginning in March 2013. They'll first start off with the new account number for corporations for corporate tax. However, that number will eventually be used for not only your corporate taxes, but for sales tax and employer withholding. So it'll be, instead of having multiple numbers, you'll have one number that will account for everything. And then secondly, corporate tax ledgers will no longer be available. These ledgers are usually state what your corporate income tax liabilities and payments, as well as capital stock and foreign franchise payments throughout, dating back to your existence in doing business in Pennsylvania. They're very detailed. With this modernization project, they will no longer be available. So we do definitely recommend that if you haven't gotten an updated corporate tax ledger, you should request that with the Department of Revenue. If you don't know how, definitely feel free to shoot me an email at the end of this webinar, and we can send you their contact information. Just talking with some of the Department of Revenue employees that we are friends with over there, I think the overall the project will be very successful, and it'll make things a lot easier in the years to come. However, there will be some growing pains. So definitely another reason to keep the request of corporate tax ledgers. If you've had payment discrepancies with Pennsylvania in the past, it might be good to have an updated corporate tax ledger just to make sure that all payments are accounted for and at least you have a copy in case anything gets mixed up in this transition. And lastly, for Pennsylvania, capital stock foreign franchise tax, it will continue to phase out. The rate's been continuing to go down, and in 2013, for tax years beginning in 2013, that'll be the last year that capital stock foreign franchise tax is in Pennsylvania. So 2014, we will no longer expect that.
Thank you, guys. And thank you, everybody, for joining us for today's webinar on a 2013 tax update, brought to you by McKonly and Asbury. We will be sticking around for a while to answer some of your questions that have come in, so please continue to submit them to us through the chat function in the webinar. As a reminder, you will be receiving CPE credit for attending this one-hour webinar. CPE certifications will be sent out via email within the next week. You will be receiving a follow-up email to this webinar with a link to a short survey about the webinar that we would appreciate your feedback on. We will also be posting a recap of today's presentation on our blog at www.macpass.com. Look for that post to be up shortly. And a final reminder, we wanted to keep you notified of our upcoming webinars. You can see our next one will be on February 21st, and that will be an accounting and auditing update. All of our webinars and events can be seen on our website as well at www.macpas.com. And so now we're going to go back to Mike and Dan with some questions.
Well, a couple good ones have come in. Mike, we'll start with one specifically addressing a question on RCT 101s. Will the form RCT 101 be required to be filed in 2014 if there is no longer a capital stock tax due? What do you think, Mike?
Well, that's actually a very good question. I guess the way to answer that is probably yes and maybe. For those of you who don't know, just to give you a little background, the RCT 101 is the corporate tax report for Pennsylvania. Currently, C Corps, S Corps, and LLCs are required to file the RCT 101, and there are three components to the RCT 101, corporate net income tax, capital stock / foreign franchise tax, and corporate loans tax. All three entity types are subject to the capital stock and loans tax portion of the report, but only C Corps are subject to the corporate net income tax. So for C Corps, definitely yes, the RCT 101 report will be still be required because corporate net income is not going away. Loans tax is still in place, but it is a very small revenue producer for the state, so that might no longer be included on the RCT 101 in 2014. If that's the case, S Corps and LLCs would most likely not be required to file the RCT 101 anymore.
Thanks, Mike, for walking through that. I think it still remains to be seen exactly how that will pan out, but that certainly makes sense on what we believe will happen starting in 2014. Two questions that came in relative to individual income taxes. The first one is, were education tax credits extended? And the answer is yes. The qualified tuition and fees deduction was put back in place retroactive to the beginning of 2012, and then the other education credits we have, including the American Opportunity Credit, were actually extended through 2017. So we still have our education credits in place for qualifying education expenses, which are post-secondary education expenses. Another individual income tax question that came in was, is the cost of employer-provided health insurance taxable starting in 2012? And the answer is no. Starting in 2012, employers do have to report the amount of health insurance premiums paid for their employees, employee spouses, and dependents, but this is not taxable. And there was actually, and we've mentioned this in another webinar, there was a Kiplinger spam email, not truly from Kiplinger, but cited as such, going around stating that the cost of employer-provided healthcare started to be taxable in 2012. That is not true. It is just reported, which means we will know exactly how much tax can be generated from changing that provision, but employers can still provide healthcare to their employees, dependents, and spouses if it's qualifying in a tax-free manner. Looks like we do have time for one more question, and Mike, I'm going to give you this one, and it seems like a pretty loaded one, but will states follow the new bonus depreciation in Section 179 rules, in your opinion?
That's another good question. I'd say it's a little too early to know for sure what parts of the American Taxpayer Relief Act certain states, each state would follow. But I would expect to see more states release publications stating whether they conform to the act or not within the next month or two. Strictly for depreciation purposes, it's probably a safe assumption that states will continue to treat accelerated federal depreciation in the same manner as they had before. Essentially, the act is just extending the federal rules that were already in place. Just for an example, Pennsylvania purposes, 50% bonus distribution is not allowed for either C corporations or pass-through entities. As you recall, there was a brief time when Pennsylvania followed the bonus depreciation, and that was when it was 100% near the end of 2010 and for all of 2011. But again, that was only for C corporations. Pass-through entities never followed federal bonus depreciation. And then for Section 179, Pennsylvania only allows $25,000 per taxpayer for pass-through entities. This threshold is also $25,000 limited at the individual shareholder or partner level as well, so much smaller than the federal level. And that will probably continue to be the case for Pennsylvania. For C Corps, the 179 limit is the same as federal. And again, expect that to be the same with the extension.
Thanks, Mike. And we will have one more question that will sneak in here, which was, can you explain what the marriage penalty is? We've heard about that being fixed as part of the American Taxpayer Relief Act. The marriage penalty essentially is not truly a penalty assessed on people for being married, but it was a term that was coined to explain that if the tax brackets were not structured correctly, a married couple would actually pay more federal income tax than if they were single and their income was earned and taxed separately. So essentially the married filing joint brackets are made and attempted to be structured to say that you will not pay more tax as a married filing joint couple than you would have as individuals filing single. Again, so they made some corrections to the brackets to ensure that there is no marriage penalty, quote unquote. Well, that's all the time we have for questions.
All right, thank you, MJ. All right, thank you everybody once again for joining us, and we hope we'll see you at our next webinar. Have a great afternoon.